Hey everyone, it's Mike Hambright with Flipner.com. Thanks for joining us for this episode of the Expert Interview Show, where I interview leaders and entrepreneurs from across the real estate investing industry. If you're a member of Flipner.com already, thanks for joining us again today. If you're not a member, go check out Flipner.com. You can get a free membership in literally about 15 seconds. We've got a lot of awesome stuff going on, lots of access to properties, and given that this is episode number 294, we have hundreds of hours of great content of interviews with experts in our space. So again, this is episode 294 with John Heyer. John has been on the show before, almost 200 episodes ago, so hard to believe that it's been that long. But John has got great information. He's a real estate investor, a tax attorney, and he's an accountant that has just a tremendous amount of experience helping real estate investors. And as we sit here this time of year, a lot of people are feeling the pinch with the tax man. I know we're working hard to get our taxes done, and it's kind of a messy time. And all along, you're thinking, I can't believe that I give up this much of the pie. And actually, a friend of mine just recently said, just 2 weeks ago, we were at an event, and he said, if you're not spending as much time keeping the money you made as you are making it, then you're probably paying too much in taxes. So pretty insightful. And John's going to talk to us a lot about that today. In fact, we're going to talk a lot about self-directed IRAs and 401ks and how you can really minimize your tax bill and some tools that are out there for everybody listening to this show today. So as you know, we break the show up into two parts now. The first part, we're going to talk about self-directed IRAs and 401ks. And then in the second part, the taking action segment of the show, John is going to share his favorite technique of somebody that recently put, or not recently, probably over time, put 50 rentals in a self-directed IRA account where the earnings and the eventual sale is completely tax-free. How does that sound out there? So John, how are you today, my friend?
Very good. Very good.
I'm excited. I just told you right before this, and I wasn't blowing smoke. I really love talking to people about minimizing taxes because I have paid a ton of taxes, and it's just painful. I'm all for doing my fair share, but certainly feels like I've done well more than that over the years.
Yeah, it's going to get worse. Socialism's very expensive, and now that the bill's coming due, the government and the IRS are pushing heavy. So it's going to get interesting.
Yeah. Awesome. Well, why don't you take a few minutes and introduce yourself and tell us a little bit more about you?
Sure. I'm a lawyer, accountant, and investor, and that's probably an order of competence. For example, I'm very good at spotting deals with real estate. I'm a terrible manager. I've had several mobile home parks that I just don't manage them very well. We do much better with single-family houses. We bought some during the crash. We've done pretty well with them. We want more of those. So I do invest mostly low-income to blue-collar single-family rentals. We've done a few flips, and like I said, the mobile home parks, but just not my shtick. I'm also an accountant. I did sell my accounting and return practice about a year ago, mainly because I was doing too much, just spread too thin, needed to have a life. But I've done tax returns for about just shy of 20 years, so I have a lot of experience with it. Sold the practice to my best employee. We do refer her a lot of work because whatever we come up with on the planning side, she's able to implement on the return and bookkeeping side, and she does serve people all over the country. She's great. So now I spend most of my time as a tax lawyer focused really on self-directed IRAs and 401ks, real estate investors, and small businesses, and roughly in that order. And most, I would say most of the 401k IRA people are in some sort of real estate. We find a few of them that aren't, but for the most part, we find that they are. And I would say my claim to fame on that is, unlike a great many lawyers, I mean, I understand and get into self-directed accounts. It's very rare to find a planner who gets into it. But I've also now gone to tax court twice to defend clients. They got audited. Thankfully, I dealt with the audit, which allowed us to set the stage for a victory later. And we eventually won right before trial. The IRS pushed it. I mean, we had to actually stand up and present in front of the judge in one case. And then the IRS decided they wanted to settle. And the settlement was really good. My client owed $0.
Wow. That sounds like a good settlement.
And the second time around, same one. The IRS started off by saying he had $400,000, and he ended up owing $0. And by the way, these people were all over the country because the tax court is a circuit court. So they meet in all the cities. We always file in Columbus. That way the clients don't have to pay for me to go somewhere. But bottom line is, between the planning side, but also solving IRS problems, audits, collections, that kind of thing. I've gotten a lot of experience. And what I can say that very few can is that I've gone to tax court twice now on IRA issues. So I have a much better idea of how the IRS looks at things from having had to deal with them up to almost the highest level
Yeah.
on that.
That's powerful. I can tell you, I've given advice before, and this is advice that I learned over time because unfortunately I've been through an IRS audit that was painful. They found no wrongdoing. It was just a painful process. But I can tell you, and I know that you don't run your accounting practice anymore, but for those that are listening, when you're looking for an attorney or somebody that knows what they're doing, a CPA, it's not a bad thing. You want to find somebody that is not afraid to be audited. I've had accountants before that have massive practices and they will do everything they can they've never been through an audit and they do everything they can to not be audited, which means they're probably not taking it close enough to the line to save you money.
Yeah, they pay a lot more than they need to because look, it's the personalities. Think of the people you went to school with, the ones who became lawyers, the ones who became accountants, the screwed up ones who did both. The attorneys tend to be more creative and aggressive. Accountants tend to be more in the box. They don't want trouble. They can be a little timid. We get a lot of audit referrals from accountants who, for that very reason, they're terrified. Yeah,
if you really think of it, the average accountant, or any accountant, they're not typically paid more if they save you more money. So why would they go through the trouble of taking it too far to the line if they can just stay safe?
I'll take it to another level. The IRS expressly tries to intimidate them. Right? Yeah. I went through a very special audit as a professional. They said, we think as a professional, not just a regular audit, but as a professional, you're giving bogus advice and we'd like to put you away. And it was because I didn't know this at the time. I didn't find out till much later. A client of mine committed fraud. And so they audited everybody who had any connection to him.
Okay.
We came out of it clean as a whistle. And I mean, it got to the point in the audit where I turned it around and started asking them questions. Yeah. And very, of course, politely.
Yeah.
But firmly.
Right.
And so I wasn't intimidated because it's what I do. I'm a lawyer. I fight.
Yeah.
But a lot of these accountants, in order to avoid that, they'll do anything, including have you pay a lot more.
Sure, absolutely. Well, John, let's dive in. Let's start talking about this time of year, people are preparing their taxes and maybe paying big tax bills and maybe thinking about, man, I've got to find a way to minimize my tax bill as a real estate investor. And fortunately for real estate investors, there's a lot of ways to do that if you have the right advisor. Is that right?
Oh yeah. I think there are a ton of ways to do it. Now, my favorite is make it so the income's not taxable to begin with. But it depends on where you're at in life. How realistic is that? So there's, of course, structuring entities. There's making sure you write off everything possible without going overboard and overdoing it.
Sure.
I've seen some investors who are so aggressive, they go to the opposite extreme and they're sort of begging for an audit.
Right.
There's the sweet spot. You want to be aggressive. You want to write things off, but you don't want to do things that might trigger an audit. Or if it gets triggered, you still want to win. You want to be, how do I put this? If it's gray, which is okay, you want to make sure your batting average is really good. So if I take, let's say, 20 aggressive deductions, if I pay on one or two, I'm not really worried about it. Even if I pay some penalties, so what? If you do the math, I'm way ahead for having done it. So a good example of that, before we dive into the IRAs, because that is my favorite area, but a good example of that is just writing off daily things. And a lot of people are aware of it, but they don't track it. So writing off your meals, here's a great quick example. How to write off really nice furniture for your personal home. It's not that hard. What you do is, in my case, my business as a lawyer, I have an office. I have nice furniture. I buy furniture for my office that I would like to have in my home. I depreciate it or write it off right away, but I hold it for 5 years. Once I've had it for 5 years and it's at zero for tax purposes, there's a rule that says I can distribute it from a non-corporate LLC, so a regular LLC. There's no tax on doing that. So chairs and desks and leather sofas after 5 years go to my house, but it was after I got the write-off.
Yeah.
And there's a way to do that.
Okay. So let's jump into to IRAs and 401ks. Where do you want to start?
First of all, high risk, but also high opportunity. We'll talk later in my favorite techniques how one guy makes $250,000 a year, 100% tax-free. He doesn't pay state tax, he doesn't pay federal tax, he doesn't pay Social Security tax. And it's so brilliant how he did it, and it's so simple the way he did it.
I'm looking forward to that.
So we'll talk about that. I'll tell you, the high risk is because of prohibited transactions. So there's a code section, 4975. that talks about prohibited transactions and what can and can't you do. And most people think they know what's a prohibited transaction. Hey, I can't lend money to my dad because he's an ancestor, but I can lend money to my uncle. Not necessarily. There are another set of rules that talk about using the IRA for your personal benefit. And if you structure the loan to your uncle in a certain way, are you really trying to benefit him and indirectly yourself and your family versus benefit your IRA? So you could lend money to your uncle and it could still be a prohibited transaction. That's just one example.
Yeah.
Bottom line is, if you do a prohibited transaction in an IRA, the IRA dies. All the money gets distributed. You pay a bunch of penalties. What we tell people is, if your IRA has a prohibited transaction, you should expect about 50 to 60% of it to go to the government. So that's the high risk side. You got to structure around prohibited transactions. You need good advice, good education, and good advice to structure around those issues. And there are a lot of subtle ones.
Yeah. So the risk is you could be, aggressively putting things away in your self-directed IRA for a long period of time, 20, 30 years. And then right before you're going to retire or whatever is going to happen, you do one transaction, you screw one thing up, and it could blow the whole thing up.
That's exactly right. Let me give you an example. And this illustrates, as you and I were chit-chatting, I like 401ks, all things being equal.
Yeah.
I like 401ks a lot more than I like IRAs. I prefer a self-directed 401k if you're eligible to a self-directed IRA. Now, if you're not eligible for the 401k, still do the IRA. And maybe one day you'll be eligible for a 401k and you can roll over into it. Here's why I like one reason I should say I like 401ks more. We're going to make up a prohibited transaction for $1. You lend your mother $1. Now, we all know that's a prohibited transaction. She's an ancestor. Your IRA cannot do business with her. You cannot lend her money. Let's say that we have an IRA and a 401k. Each one of them has $1.6 million in it. That's not an accidental number. You'll see why I picked that in a minute. So it each has 1.6 mil. You lend your mother $1 out of each account. Now in the IRA, it destroys the IRA. So all that 1.6 is distributed, and obviously you're in the highest tax bracket, plus you pay a bunch of penalties. You're probably going to pay about 60% of that money. Well, what's 60% of 1.6 mil? A mil. So a $1 transaction in an IRA that's done wrong can cost you $1 million. And people say, well, the IRS would never do that. What?
Right. They're hungry.
Yeah, absolutely. They're hungry. If you did the same thing in a 401k, prohibited transactions are penalized at a much lower level in a 401k. Specifically, it's 15% of the transaction, and it doesn't blow up the account. Yeah. So what was the transaction here? $1. Well, what's 15% of $1? 15 cents.
Right.
Big difference.
Yeah.
That's one reason I really like 401ks. And there are other reasons, the ability to contribute more. You can borrow some from them. Better asset protection in terms of protecting the account from your personal creditors. So those are all good reasons as well.
Yeah. I know we're not going to be able to cover a whole lot of this, but maybe at a high level, John, why don't you talk why you would do, I know there's a lot of benefits to a solo 401k versus a self-directed IRA. It's self-directed solo 401k. That's a mouthful, right? Versus a self-directed IRA. Maybe just at a real high level, just take a minute or two and talk about, even though there's all these benefits, here's why those that don't do it can't do it.
I'll give you two instances I see. One, you just don't qualify for a 401k for whatever reason. Usually you don't have a business that brings in earned active income. You just don't qualify for the 401k. So the IRA is better than nothing, a lot better than nothing. The other one is this. With Roths, the Roth 401k and the Roth IRA rules are a little bit different. With a Roth 401k, when I hit 70 and a half years of age, I have mandatorily to start distributing money from the 401k Roth. Where with a with a Roth IRA,
around, right?
Yeah, with a Roth IRA, I'm not forced to distribute. So we do see people at age 70 and a half roll their Roth 401k into a Roth IRA to keep from being forced to distribute. Maybe they don't need the money. Maybe because passing on a Roth IRA is very powerful. Yeah. Because whoever inherits it gets tax-free income for life, even if they're not retirement age. That's huge.
Yeah.
So that's another reason. that we see Roth 401ks rolled into Roth IRAs.
Okay. And some of it too, just to clarify, is whether you have employees in your company or not, right?
Well, you can have a 401k if you have employees. You just can't have a 401k solo. So you can have a self-directed 401k Roth and have employees.
Okay.
What's the difference between a regular 401k Roth and a solo 401k Roth? Administration. You should plan on spending an extra, I don't know, $2,000, $2,500 a year on administering the 401k where there are employees versus the 401k solo where you don't have employees. It's cheaper, simpler, easier to run.
Yeah, I see. Okay. Awesome. Well, what are maybe before we kind of dive into sharing your example here, maybe you could tell us this time of year. I guess here we're coming out. This show is going to be coming out in March, and so it's really kind of late for people to be doing things. We're going to be kind of at the end of March here, but talk about what folks should start if they missed the boat on some things. What maybe how they can make sure that for 2016 they take advantage of some of the things that are in place if they're not already to kind of minimize their tax bill.
That's a long list. One, where entrepreneurs fall down is record keeping.
Yeah.
Some of them research, listen to this show, read books, buy courses, pay for education, and learn how to save taxes and never properly implement it. Why? Because their records are horrible. Same thing with maintaining entities. So A, learn how to maintain records. And B, if you're no good at it and you make enough, delegate it. I would say learn general tax savings techniques. Talk to people who are more aggressive, more creative, who know your industry. If you don't have an IRA or 401k, and by the way, the same rules that apply to IRAs apply to health savings accounts and Coverdell educational savings accounts. If your kids are going to private school, you can pay for K through 12 tax-free through a Coverdell educational savings account. It works a lot like a Roth IRA. Your healthcare costs should be paid through a health savings account. Those work a lot like Roth IRAs. So the planning techniques that work for IRAs work for 401ks, work for HSAs, work for CESAs. But if you procrastinate, which is an entrepreneurial disease, you procrastinate, you don't do what you're supposed to do, you don't set it up, then it's going to be a problem. I apologize. I had my phone on.
That's all right.
Not mute. Let me turn it down.
No problem.
There we go.
So would you say that some of the process, of course, people have to keep good records for all this. Would you say that if people are listening to this today, where they start is just to get with a good custodian and get an account set up to at least kind of get that process moving?
I would say act, first of all. Yeah, get with a good custodian, set up an account, get some education, some of it out. See, for 401ks and IRAs, there's some written material out there, but not a lot of it's very good. So that in that industry, there's still a lag. Now, for real estate investors on non-401k tax savings issues, there's some decent books out there that give you a decent idea. But I'd say get a good custodian, get a good advisor. If people are going to be cheap and not pay the advisor, understand I'm going to get your money one way or another. I'm going to get it now ahead of time and a lot less of it planning ahead. Or I'm going to get more a lot later when you run into problems. Or I won't get any of it. It's just the government will get a bunch of it.
Yeah. Who would you rather have? Is a little bit to your tax advisor in the grand scheme of things, or a lot of it to the IRS, right?
Yeah, no matter what you're going to pay, the question is how much went into whom.
Right.
But one way or another, you're going to pay. So take the time, do the planning. Even if you're a brand newbie, I mean, we take clients of all sizes. We'll get brand newbies. Now, knowing that they're on a limited budget, we try to limit the call to an hour. We try to give them as much homework to do because their time isn't worth as much typically because they're getting started, right? Then you get someone older, more experienced with a bigger portfolio, a bigger business. They pay us to do more because their time is worth so much more.
Sure.
So there's a spectrum, but get a good advisor. And if you don't mind the shameless plug, we're at IRAlawyer.com. We are taking clients, hint. There, that was shameless. But there's plenty out there in terms of advisors. Make sure they're in real estate, they've got the experience, and that they're aggressive. As you started saying, don't get some wet noodle who just basically asks you to cut the biggest check possible to the IRS to minimize their risk.
Right, right. And in terms of an advisor, John, maybe you could just tell us one last thing before we jump into the taking action segment here, is differentiate between a custodian. There's a lot, I know you work with all the major custodians, so they're prohibited from giving legal advice, right? So they can give you some general information. Maybe you could kind of differentiate an advisor in this space versus an actual custodian.
The custodians will provide some educational content, but that content is not custom designed to serve you. They haven't been in audits. They're not going to take on the liability of giving you legal advice, and if they did, the Supreme Court in their state would spank them.
Yeah.
So they can't give advice. They do give some education that gives you a basic understanding. I would not act just on that education. It's too general. You need something directed at your specific circumstances. Remember what I said. This is both a high reward, hey, no taxes, but also high risk, oops, prohibited transaction sort of activity. Yep. So the custodians can give you a heck of a start, but they're not the end all be all. And they'll be the first ones to tell you that. That's why you sign something that says they're not liable if you take their advice.
Right, right. Awesome. Great. Hey everybody, it's time for the taking action portion of the show. If you're hearing or watching at this point in the video, you're probably watching us on iTunes or YouTube or somewhere else where we don't recognize you as a registered member. So we'd love for you to join us for the rest of the show, but only our pro and elite level members have access. You also have access to hundreds of other interviews, and we have almost 1,300 off-market properties listed on FlipNerd.com right now, which only our members have access to. So lots of great stuff on FlipNerd.com. This is show number 294. So to see the rest of the show, to upgrade and see all the premium content I just mentioned and really a lot more, go to FlipNerd.com/show 294. Are you a member of FlipNerd.com, the most robust real estate investing platform in existence, where you can find off-market wholesale deals and great vendors literally in your market? You can get access to advice from experts and learn about local clubs and events right in your backyard. If not, please visit FlipNerd.com and register for a free account. You can register in less than a minute. It's pretty much the coolest site that's ever existed in the real estate investing industry. So get on over to FlipNerd.com.